Retail traders and institutional traders are two distinct groups of market participants with different characteristics, trading strategies, and levels of influence in the financial markets. Here's a comparison of retail traders versus institutional traders. Retail traders are individual traders who trade with their personal accounts, often from home or small offices. They typically trade smaller volumes compared to institutional traders and may have limited access to resources and market information. Institutional traders represent large financial institutions, including hedge funds, mutual funds, pension funds, banks, and proprietary trading firms. They trade on behalf of their clients or the institution's own account and often have significant capital, resources, and expertise. Retail traders typically trade smaller volumes compared to institutional traders. Their trades may range from a few hundred to several thousand units of a financial instrument. Institutional traders trade large volumes of financial instruments, often in the millions or even billions of dollars. Their trades can significantly impact market prices and liquidity. Retail traders often employ a wide range of trading strategies, including day trading, swing trading, trend following, and algorithmic trading. They may also use technical analysis, fundamental analysis, or a combination of both to make trading decisions. Institutional traders typically have access to advanced trading technologies, data analytics, and research resources. They may employ sophisticated trading strategies, such as statistical arbitrage, algorithmic trading, and high-frequency trading, to capitalize on market inefficiencies and generate alpha. While retail traders collectively make up a significant portion of trading volume in the financial markets, individually, their impact on market prices and liquidity is relatively small compared to institutional traders. Institutional traders have a substantial influence on market prices and liquidity due to the large size of their trades. Their buying or selling activity can move market prices and trigger trends or reversals. Retail traders may have limited access to financial resources, market data, research, and trading tools. They often rely on online brokers and trading platforms for access to markets and execution services. Institutional traders have access to a wide range of resources, including proprietary research, market analysis, trading platforms, and advanced order execution technologies. They may also have direct market access and access to alternative trading venues. While retail traders and institutional traders have different characteristics and trading capabilities, both groups play important roles in the financial markets. Retail traders contribute to market liquidity and diversity, while institutional traders provide liquidity, price discovery, and market efficiency.
In this video, I want to explore something that is in the mind of many traders in all markets, which is the differences between retail trading and institutional trading. There's a lot of mystery surrounding the institutional realm, and consequently, there's a ton of misinformation about the way things actually happen. Many retail traders end up developing a bias with an element of conspiracy theory in relation to institutional traders. To raise that, we need to understand why banks trade in the first place. Whenever a bank lends some money to a client, it receives a risk attached to this transaction, which is the risk of the client not being able to pay the money back. In other words, one of the most common activities of a bank, which is lending money, creates a passive risk for its treasury department. It's simply too dangerous for a bank to keep exposing itself to the risk of not getting paid back because there are billions of dollars involved. Despite having highly advanced credit evaluation techniques, the risks are still high when it comes to lending money. This is partly what created the 2008 financial crisis. Banks were lending money to people who really couldn't pay them back. The result was that people who couldn't even pay their rent ended up borrowing money to buy 2, sometimes 3 houses, for example. The problem there is that if a person doesn't have enough collateral or doesn't earn enough income, she simply won't be able to pay the money back to the bank. This was obviously a bubble because the fact that many people borrowed a lot of money meant a significant increase in the real estate market. When the time to honor their debts started coming, people simply couldn't pay it because they didn't have enough income or collateral. In summary, banks lent a lot of money and they didn't get it back. Anyway, my original point is that when a bank lends money, it needs to offset that risk somehow because that risk keeps arriving at their hands in a passive way. The way banks have to offset this risk is by trading, meaning that they will offset the passive risk by engaging in active risk. Unlike popular belief, the goal of a bank is not to rip the money out of the pockets of retail traders. Now we arrive at the problem of how exactly institutional traders will do that. It's simply too risky for a bank to hire a bunch of traders and let them trade millions of dollars with the techniques used by most retail traders. Institutional trading relies much heavier on mathematics and statistics to build trading models, simply because the role of these sciences is to erase human biases. Just imagine an institutional trader that is assigned with the task of trading $100 million to offset the risk of a massive operation where a bank lent money to an oil company. It's simply not realistic to expect that this trader is going to be left with his cognitive biases to trade this amount of money using technical analysis, and here lies the fundamental difference between retail trading and institutional trading. The reality is that the conventional techniques most of us are used to are easy to learn because they have no prerequisites. In other words, technical analysis, for example, is a visual way of understanding the markets. It assumes no previous knowledge in mathematics and statistics, meaning that pretty much any person can learn it and start applying it. The problem with that is that since it's a visual way of interpreting the markets, it's highly susceptible to cognitive errors that are very well documented by behavioral economics, as I have said many times here in the channel and in my courses as well, especially in the Fractal Flow Strategy course. Our cognitive biases get amplified with risk, and institutional traders deal with the risk that is far beyond the risk assumed by even the most over-leveraged retail trader. The solution to this problem is to rely on heavy mathematical statistics to build training models that are 100% objective and, perhaps most importantly, that have a known probability of success with a confidence interval. That means that institutional trading techniques are a lot harder to learn than price action, for example. But once you learn them, they are actually easier to apply because they become highly mechanical. You might ask yourself why these trading techniques are not mainstream by now, and you might speculate that it's because banks try to keep these strategies as a secret so nobody else uses it. That is a false belief. These trading techniques are known, and they are not kept as a secret by institutions simply because it wasn't their invention. The true reason these trading techniques and models are not mainstream is because they have many prerequisites to learn. As I said before, they relied on very advanced mathematics and statistics. The fields of study that deal with this particular problem are mostly econometrics and something called stochastic calculus, which has absolutely nothing to do with the stochastic indicator you see in trading platforms, which is simply a joke to people who understand the true mathematics of time series analysis. The problem here is that to learn econometrics and stochastic calculus, a person needs a good background on linear algebra, especially solving large systems of linear equations through matrices and finding eigenvectors and eigenvalues. The person also needs a very good background on statistics and probability theory, and to understand stochastic calculus, the minimum requirement is the understanding of differential and integral calculus. Learning all of that is far from easy, of course, but it is what institutional traders use, and with good reason. Ironically, once you understand an econometric model, it's easier to apply than a price action analysis due to the nature of these two distinct methodologies. What I intend to do here in the future of the channel is to provide all the necessary prerequisites for you to learn the econometric models as fast as possible, and the full econometric models too, of course. There is a tremendous advantage in the retail trader learning institutional methods because a person doesn't have to meet a series of legal requirements of a bank or a fund, for example. These regulations significantly decrease the performance of these institutions. An individual investor or speculator can do whatever he wants to do with his money without any of these regulations. That's an incredible freedom that most people don't realize they have. It all comes down once again to the discipline of learning complicated things. By learning institutional trading methods, an individual can have the freedom of using the best of what econometrics has to offer in terms of time series forecasting and institutional trading, while having no necessity to meet regulations that are intended to stop large institutions from exploiting the extreme sides of capitalism. That leads us to a powerful conclusion, which is the fact that individual traders have more freedom than large institutions, despite what the common belief that individuals stand no real chance in the market. That means, however, that the constant seeking of true knowledge is what is going to truly set you free financially. Remember that technical analysis is relatively easy to learn, but it can be difficult to apply due to the way in which it twists with our complicated biological heritage. That, of course, doesn't mean that it doesn't work. It means it provides a certain type of challenge to those who use it, and it is, of course, in the best interests of those who use it that they acquire true knowledge about these challenges. That's basically what I try to do here in the channel with my free videos and my paid courses and books. Institutional trading, however, takes the road of minimizing the risk as much as possible by relying on a deep and wide mathematical and statistical apparatus. The main driver of scientific endeavors is precisely the attempt to avoid our own flawed perceptions. It's in your own best interest that you truly apprehend the differences of these different schools of thought that attempt to understand the complexity of the market. So that's it for this video. If you wish to learn how to become a real trader, check out the courses I provide in the video description. If you like this sort of video and wish to support their continuous creation, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your comments below. Thank you for watching. Take care.